And the funny thing is, a lot of people talk about bad debt deductions, but they really don't understand what those mean. So in today's conversation, I'm going to break down for you IRS Form 1120 updated rules for bad debt deductions. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How are you today? I hope you are doing fantastic. I'm doing marvelous, if you were to ask me. If you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. In today's convo, we're going to have a clearer discussion about the rules for bad debt deductions as they apply to Form 1120. Now, the information we're sharing with you today stems from our own research as well as data gathered from the IRS official instructions. So if you need more information, I advise you to head to the 3 IRS web links indicated on the screen, or you want to contact your tax advisor. So the first snapshot we have here is the topic number 453, bad debt deduction. IRS publication 550, investment income and expenses. And the third one is the publication 335, business expenses. So those are pretty good resources if you want to dig a little deeper when it comes to bad debt deductions on all corporate tax returns. Now let's talk about when you can use bad debt to reduce business income. So being in business is kind of hard. We all know that. This is hard work, especially if your business is overrun with bad debts and high taxes. So sometimes customers or clients just won't pay for the service or products you have provided, right? So no matter how many statements you send out, even if you take the customer to small claims court, you may not get your money. And these things happen, unfortunately. But there is a way to make lemonade from this lemon of a customer. So if your business has already shown, let's say, the expected revenue from customer payment as income for tax purposes, and they later become bad debts, you may be able to reduce your business income by the bad debt amount. This is fantastic. And what is considered bad debt? Bad debt, or an uncollectible account, is actually a receivable owed by a customer, client, or a patient which the business owner or creditor is not able to collect. All right. Bad debts may be written off by the creditor at the end of the year if it is determined that the debt is uncollectible. So the IRS says the bad debts include loans to clients and suppliers, credit sales to customers, and business loan guarantees. So this trifecta is very important for the IRS in terms of categorizing bad debts. So how do you actually write off bad debts? Now you can take them off the business income at the end of the year. So in order to write off bad debts, your business must use the accrual accounting method. So under this method, you can show income when you have billed it, not when you collect the money. And if your business operates on a cash accounting basis, you cannot deduct bad debts because in cash accounting, you don't record the income until you have received the payments. So in this case, you just don't receive the income, so there is no tax benefit to recording a bad debt, right? Let me just show you an example of how bad debt accounting works. Let's say, for sake of simplicity here, folks, all right? Let's say you sell $10,000 worth of products to a customer. So I'm going to break it down for you what happens under the cash accounting method and the accrual accounting method. Let's first start with the cash accounting method. So under the cash accounting method, you only record the sale when you receive the money from the customer. So if the customer doesn't pay, you don't record the sale. So at the end of the year, if you haven't been able to collect the money, there is no bad debt. There is no revenue. There is nothing because there was no sale recorded. The transaction just didn't pan out. So that's for cash accounting. Under the accrual accounting method, things are a little different. Because under that method, you record the sale at the time you bill the customer. So your sales records for the year include the $1,000, the $10,000 rather, right? Because the sale of the amount was $10,000. And so if you determine that you're not going to be able to collect this $10,000, you must manually, and this is a manual operation here. Like if you use tax software, it won't do it for you. You have to manually go into QuickBooks or FreshBooks or Xero or Wave and do the recording there. You must manually take the amount out of your sales records before you prepare your business tax return. Now, one thing I want to say here is that I mentioned before that you only do this, you only get into this sort of activity at the end of the year. You don't have to wait until the end of the year to actually write off bad debt. If you believe that things happen, you believe that an account is uncollectible, you can actually do it during the year. However, when it comes to tax purposes, you can only record the amount at the end of the year. Just want to clarify that aspect. Now, let me explain to you clearly how to take bad debts off your business tax return. Remember, you will need to run your business on the accrual accounting method to be eligible to take deductions for bad debt losses. Okay? There are a few steps you have to pay attention to. There are steps you must take to write off bad debt at the end of your tax year. You must wait until the end of the year, again, in terms of for tax purposes. Why? Why does the IRS impose on small businesses, on all businesses for that matter, to wait until the end of the year? Because guess what? Someone might pay during the year. Let's say you actually write off an account that you thought was uncollectible in February. And come May or June, there is a change of fortune in the client's activities, and they send you a check. Now, from an accounting perspective, from a purely financial accounting perspective, there are reversal entries you can make. But for the IRS doesn't care about that. The IRS wants to wait to make sure through the whole year that the person hasn't paid you, so you can actually claim that bad debt. Okay, so here is how you do things. You need to prepare something called an accounts receivable aging report. This is actually a report that shows all the money owed to you by all customers, how much is owed, and how long the amount has been outstanding. It's called AR aging report. You also want to put forward, you want to total all bad debts for the year. So you'll need a list of all customers who have not paid during the year, and you should only make this determination at the end of the year for what I just explained to you, and only if you have made every effort to collect the money owed to your business. So the IRS wants to see a substantial effort on your end before it actually validates the deduction, the bad debt deduction. All right. And you need to include, and this is the third step. So first step, you need to prepare an AR agent report. Second step, you need to total all bad debt for the year. And the third step, you need to include the bad debt total on your business tax return. So if you file your business taxes on Schedule C, for example, and which is actually the topic of this show, you can deduct the amount of all the bad debts. Each type of business tax return has a place to enter bad debt expense. All right. Now, service businesses and bad debts. Now, in the same manner as cash accounting, you cannot record a bad debt expense deduction if you don't get paid for a service. You may have a receivable, but you must collect the receivable in order to record the income. So no income recorded, no bad debt. Simple as that. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another session of the Awesome Sweetie Kiwi Show. We're also having a very informal conversation, if you will, about bad debt deductions on tax returns. And let me give you the IRS rules for deducting business bad debts. It's really not uncommon for high-income individual taxpayers to hold uncollectible or worthless business debts. So careful tax planning that maximizes the business bad debt deduction can actually help you minimize the taxpayer's overall economic loss. And there are a few things you can do. First, you need to establish a bona fide debt with a related business. And then you need to distinguish business from non-business bad debts. This is very important in terms of your fiscal strategy here. What is a bona fide debt? This is one that arises from a debtor-creditor relationship based on a valid and enforceable obligation to pay a fixed or determinable amount of money The taxpayer must be able to show that it was the intent of the parties at the time of the transfer to create a debtor-creditor relationship. In other words, what am I trying to say? This sounds a bit like legalese. Let me break it down for you. In other words, the taxpayer must be able to show that at the time of the transaction, he or she had a real expectation of repayment, and there was an intent to enforce the indebtedness. So a formal loan agreement is not absolutely necessary to create a bona fide debt. Also, the giving of a note or other evidence of legally enforceable indebtedness is not in itself conclusive evidence of a bona fide debt. All right. So the mere fact that the debtor is a related business does not prevent a bad debt deduction by the individual taxpayer. What about, it's important to also distinguish business from non-business bad debt. So two types of bad debt deductions are allowed by the IRS. So you have business bad debt and non-business bad debt. Now, so business bad debts give rise to ordinary losses, while non-business bad debt give rise to short-term capital losses. The distinction is critical because it has an impact on your tax liability or your tax refund. So non-business bad debt give rise to short-term capital losses, and business bad debt give rise to ordinary losses. So a business bad debt often originates as a result of credit sales to customer for goods sold or services provided. So if a C corporation sells goods or services on credit and the accounts receivable subsequently becomes worthless, a business bad debt deduction is permitted, but only if the income arising from the creation of the receivable was previously included in income on the tax return, right? So consequently, for cash basis taxpayers, a bad debt deduction is generally not allowed, as I said earlier, for uncollectible accounts receivable because this amounts are not included in income until received. So that's for that's kind of important. And one thing I also want to say here is that loans to businesses owned by the taxpayer can also generate business bad debt if the loans were made to preserve the taxpayer's employment status and income earning potential, or in the course of the taxpayer's business of buying and selling businesses. So debts that do not qualify as business bad debts or non-business bad debts or possibly gifts. Another thing you have to think about when you draw up your strategy or your fiscal strategy here is to understand the business reason and to understand that the IRS wants you to make sure that business reason must be the dominant motivation for the loan. If a taxpayer is advancing a loan to a business reason must be the dominant motivation. So in distinguishing business and non-business bad debts, the question that must be asked is, does the loss bear approximate relation to the taxpayer's trade or business? In easier English, does the loss relate to the business? If so, the regulations state that the debt qualifies as a business bad debt. However, if the conditions are not clear, then the IRS will treat this as a non-business bad debt. So significant motivation between the debt and the taxpayer's business does not satisfy the requirement sometimes. This is very important, all right? And let's also talk about the business of lending money. So a taxpayer who can establish that he or she is in the trade or business of lending money normally can claim a business bad debt deduction for uncollectible loans. So in determining whether the taxpayer is in the trade or business of lending money, the IRS generally considers 6 important criteria. So the agency will look at the total number of loans made, the time period over which the loans were made, the adequacy and nature of the taxpayer's records. So here we're talking about compliance, payment history, penalty history, and so on and so forth. Criterion number 4, whether the loan activities were kept separate and apart from the taxpayer's other activities. Criterion number 5, whether the taxpayer sought out the lending business. And last but not the least, the amount of time and effort expended in the lending activity and the relationship between the taxpayer and his debtors and his or her debtors. So the amount of time and effort expended in the lending activity relates to what I said earlier about material participation. the IRS it's very adamant at making sure that people actually comply with the material participation. If you don't have material participation, what do you have? You have passive activity and passive income and passive losses. Now, before you can actually, as a company, before you can actually write off bad debt on your tax return, you need to prove something called worthlessness. This is very important. The worthlessness of a debt is a question of fact. We're not talking here about theory here, folks. This is fact. So all relevant evidence should be considered, including the value of any collateral and the financial condition of the borrower. So proof of worthlessness is best established by an identifiable event demonstrating the loss of value for the debt. So if you have casualty, you have theft, you have what we call acts of God, and so on and so forth. All right. So this is very important. And if you have bankruptcy, for example, if you have any kind of situation that adversely impacts the borrower's activity or private life, then yes. And so if you have, for instance, let's say you have a copy of the bankruptcy notice, this should support at least a partial reduction in the value of a receivable or other non-collateralized debt from the bankrupt business. So beyond cessation of the debtor's business or a bankruptcy notice, the IRS will accept the following as proof that a debt's value has declined or become worthless. So, for example, if you have the disappearance or death of an individual debtor, and if this is documented by a newspaper clipping, return mail marked deceased, etc., that's cool. If you have uncollectability of a deficiency after the property securing the debt is sold, if you have a writ of execution returned by the sheriff with a notation "no property found" or "not satisfied," that could also be good, or the worthlessness of a judgment against the debtor. So those are the four main criteria that the IRS will look at to actually ascertain worthlessness. And this is beyond the bankruptcy situation. All right. Now, if none of these items is present, a taxpayer's best documentation is likely to be a detailed record of collection efforts. So the record should indicate that the business made every effort a reasonable person would take to collect a debt. However, as I've said earlier, the taxpayer is not required to actually file a judgment against the debtor if, based on the facts, this action obviously would not improve the collection effort's success. Now, when do you claim a business bad debt? Deduction. So a business bad debt can be either partially or totally worthless, right? So if the taxpayer can collect some but not all of the debts, it has a partially worthless debt. So if the taxpayer cannot collect any of the remaining amount of a debt, even if it collected some of it in the past, the taxpayer has a totally worthless bad debt, all right? And at least from the IRS standpoint, that's how things are. All taxpayers, except for, let's say, a certain financial institutions, use the specific charge-off method to deduct business bad debts as they become partially or totally worthless. And let me just kind of talk to you a little bit about how you can deduct a partially worthless debt. Before you can do that, if you're a taxpayer in that situation, before you can actually deduct a partially worthless business debt, you must be able to show that partial worthlessness has occurred and that the amount of partial worthlessness has not been charged off on the books of the business. And you may choose from among the following options concerning how to handle the debt for tax purposes. So you can claim a deduction for any portion of the debt up to the amount actually written off in your books during the year. And this requirement to record a book charge-off means that the portion charged off must no longer appear as an asset in the business's financial records or on its financial statements, right? So that's number one. Number two, option number two, the business can always forego a current year tax deduction in favor of waiting until the balance of the debt is either collected or determined to be worthless. And it can actually claim a bad debt deduction for the entire uncollected amount at that time. It really depends. All right. And the taxpayer may treat each partially worthless debt differently. It really depends upon your situation, upon the company situation. And the IRS gets that. The IRS understands that those intricacies here. However, in no case may the taxpayer claim a tax deduction any later than the year in which a debt becomes completely worthless. This is an important I would say, indication here. So this is how you actually think about deducting. This is how you go about deducting a partially worthless debt. Now let me talk to you about how to deduct a totally worthless debt. So this kind of debt is deductible only in the tax year it becomes totally worthless. So the deduction for the debt does not include any amount deducted in an earlier year when the debt was only partially worthless. And one thing I want to say here is that the business is now required to make an actual charge off on its books to claim a bad debt deduction for a wholly worthless debt. However, you may want to do so in case the IRS later asserts the debt was only partially worthless, and this allows even a partial deduction since no charge-off occurred. Very important, right? So one thing I want you to keep in mind here is that a deduction for a partially worthless debt is limited to the amount actually charged off on the business books. And one thing we have seen in our research is that it is sometimes difficult to prove that a debt became worthless in a particular year. So if the IRS later maintains worthlessness occurred in a year earlier than the one in which the deduction is taken, the deduction may be lost because the statute of limitation for filing a refund claim has expired, actually. So for this reason, the IRS extends the statute of limitation for claiming a credit or a refund for bad debts to 7 years. All right, remember that, instead of the usual 3 years. So 7 years is actually it's pretty long time, and this is kind of cool. And this is actually the IRS trying to help taxpayers in this situation. So if any doubt exists as to the proper tax year to claim a bad debt deduction, claiming the deduction in the earliest year, you could, the thing here, you have to look at your books, you got to look at your operations, and you have to think about a little bit of tax planning here. All right. So if any doubt exists as to the proper tax year to claim a bad debt deduction, claiming the deduction in the earliest year it could possibly be allowed is recommended. So the claim should be reviewed in a subsequent year and an amended return filed for the original year if facts developed to indicate a later year is the proper one for claiming the deduction. That's what I was talking to you earlier about when it comes to tax planning. All right, folks. This is it for today's conversation. I was just quickly talking to you about IRS Form 1120 special rules for bad debt deduction. So I talked to you about when you can use bad debt to reduce business losses, to actually reduce business taxes, what is considered a bad debt, how to write off bad debts, how to take bad debts off your business tax return, and the IRS rules for deducting business bad debts. Thank you so much for your attention. I really appreciate it. I will see you next time. But until then, remember, stay marvelous.